And good afternoon. Welcome into Market Talk on this Tuesday, April 5th. Thank you for joining us, making us part of your day once again. I'm your host, Jesse Allen. Find us online, markettalkag.com. That is our home on the web. Markettalkag.com is where you could find us, all of our social media links, streaming sources, and much more. It's all online, markettalkag.com. Well, we have plenty to look at in the market trade here today with winter wheat leading us to the upside. Some good strength throughout the grain sector. Plenty of pressure in livestock, though. Let's discuss and say good afternoon and bring in our good friend Brian Splitt with agmarket.net joining us here today. And Brian, appreciate you being with us here. Another interesting day in this market trade, but really a good showing by winter wheat after those really poor crop ratings we saw Monday afternoon.
Yeah, absolutely, Jesse. The general expectation from the trade as far as the winter wheat conditions was anywhere between 32 to 47% good to excellent. So it was a pretty wide spread there. 30% was below the lowest estimate. So the futures started very strong right away in the night session, gapped higher in a lot of the contracts. Saw some pretty darn good gains, 50 to 60 cents near the highs. We did come back and finish off the highs, but I wouldn't say any major technical damage was done to the upside. For example, the December Chicago wheat, we made the contract high early March, then we had some secondary highs late March. The high today was right at the downtrend from those two peaks. So this market might need to come back and fill the gap, kind of recheck the 20 and 10-day moving averages. And I do think eventually the way the chart looks to me is that it's coiling. It's got this very large coil. It's about $1 from the low end of the coil to the upper end of the coil. So we could still see quite a bit of volatility. But if it does break out of this consolidative pattern, it looks to me like it may measure up towards $12 in the big picture. So that'll be something I'm watching for on a breakout to the upside.
Brian, do you feel like watching these wheat markets that they're maybe trying to price themselves out of the feed bunk just a little bit? I mean, both domestically and globally, just with some of the action you're seeing here.
Yeah, well, so right. When you compare our domestic values to what we're seeing globally, it seems like we're back to potentially trying to stay in the role of being the world's wheat bank and maintaining the physical supply here. And that's been that way for some time when they introduced the VSR, the variable storage rate. And we had the wheat market would typically provide quite a bit of carry so that we really didn't have the incentive to move the wheat out of the country. The owner of the wheat that had it in storage was continually rewarded to store it. And now that we look at it from a big picture perspective of global values, we're priced out of that at this point. So, yes, I think to answer your question, we're trying to keep it from being used as feed. But at the same time, relative to corn, we also need to maintain some premiums there. And speaking of corn, what a great day there. New contract highs for July on an old crop perspective, new contract highs on December for the new crop. We did finish a little bit off those highs, but just to see us making these new contract highs is great to see.
Very, very true. And those new contract highs, getting new crop corn over that $7 mark, I think that's maybe a psychological barrier for some. But really looking strong in that corn market here today. And obviously, we're getting into spring planting very slowly here, but it's going to start ramping up the next couple of weeks. And now that we got those USDA numbers behind us, I'm curious, will we see some acres shift back to corn and get closer to maybe that 90-90 split with quarter beans, Brian? It's going to be very interesting to watch.
It is. I think, in a typical year, that would be what would happen. And so we saw a pretty dramatic response from the trade once we saw those acreage numbers. The corn market was up, the soybean market was lower. We had the ratio of new crop soybeans to new crop corn correct rather abruptly to 2.03, 2.04. And that would typically say, all right, these acres are going to go back to corn. The tough part is this is not a typical year. And so, even if a producer wanted to put corn in, the potential availability or lack of availability of fertilizer in their own specific area may make that decision for them. So I've had some conversations with producers where they're willing to make that switch, and they have been able to procure the fertilizer. But in other areas, that decision, is made for them because of the unavailability of the product. So that's just part of the dynamics that we're looking at right now. I've been thinking, roughly 90.25 and 90.25. It's hard to get things much more than 180 million acres combined between corn and beans, but I was in that 90-90 camp for a while. And it may very well end up in that vicinity once we get to June. The planting conditions and the weather, once we do get in the field, may have a hand in that as well.
Well, looking over the soybean market, Brian, good strength in bean meal today, and I think that helped us a little more momentum in the soybeans. But maybe you could talk about this soy market a little bit. What are you seeing here as we get into this month of April?
Well, Jesse, you had started off with the meal, and I'll discuss that. Technically, the July soy meal contract on the lows recently went right to what would be their long-term uptrend. So soy meal held right where it should, and that was down in the low 340s per ton. We made it up to the upper 350s here on the highs today. So if we can continue to hold this week's lows, I think this meal market has some room to the upside yet. When you look at new crop soybeans, and as bearish as that report was, we were not able to really take out that $14 support below the market. We did trade through it a little bit, closed back above it, and here we are, 50 cents off of that area rather quickly. So I think it looks pretty constructive for soybeans to have the report as bearish as it was and be able to really shake it off and put some gains back on that quickly.
Well, I think looking as well, we got to factor in what we're seeing in South America, of course, and how well we get off to a start here with spring planting in the U.S. But overall, out of these USDA reports we saw here recently to wrap up the month of March last week, I mean, it just feels like some of the dynamics in the market have changed, but maybe some have kind of stayed the same. And it's especially with the soybean side, we know we've had some crop issues in South America. Where are we going to go from here? And I think it's very interesting just how everything is lined up now after those USDA reports, whether we're talking corn, beans, or wheat, Brian.
Right, Jesse. So I think the bottom line is no matter if we get, a couple of these acres shifted back or whatever the end game scenario is on the acres, the problem is still that we are tight and we need a good crop this year. And we still have the weather market in front of us. And so barring some kind of a outside market force that may cause liquidation from a macroeconomic standpoint, I think you're going to continue to have a good level of support under the market. Now, that doesn't mean that new crop corn, for example, can't come up here from the 710 level and maybe go back and retest the contract highs at 680 and a half that we had made prior to that report last week. If you think about the last correction we had, 30-cent setbacks in new crop corn after a new contract high is not out of the ordinary. And I think the trade will be willing to come in and buy the old contract high if we see a retest of that after seeing the highs made today. Now, today's highs are pretty interesting based on what levels we've achieved. One of the charts, and I had put this out on Twitter today, but if you look at a continuous chart of corn, but only looking at December contracts, and so what I mean by that is when one December contract expires, the chart will then plot the next December contract. And so what happened was in 2012, we had the drought. We had December 2012 corn make a high of 849 that year. And when the December contract for 2012 expired and the Dees 2013 contract became the front December, it left a gap on that chart. And that gap was filled today at 709 and a quarter. So that's another reason why, we seem to have hit a pretty good major technical objective to fill that gap. Again, it wouldn't surprise me to maybe back off a little bit from that, recheck the old 680.5 contract high, and then see the buying resume from there.
Brian, let's flip over to livestock. We saw plenty of pressure throughout cattle and hogs today. Cattle market, especially with, I would think higher feed prices, of course, but then you think about it as well with the stock market lower. Talk out there about interest rates. I would have to think some of that kind of fed into the cattle markets today.
Yeah, I think it was two-pronged, as you had mentioned. When you've got the price of corn doing what it's doing, the feeder cattle market, it's very tough on that. So thinking back to last week, a lot of these, your August feeders, for example, they were under pressure, but they were holding support. They were still holding their uptrend. And that report last week seemed to be the kiss of death, and we took out support, and we've seen nothing but weakness after that. And it's going to be very difficult for live cattle to maintain when you've got feeder cattle pulling things down. So I think that's, one aspect of the weakness. Recently, there's been a lot of talk about the inversion in the 2-year and the 10-year and the interest rates, that is a sign that if we're not already in a recession, that a recession is ahead of us. And so with conversations about raising interest rates, the inversion in the 2-year and the 10-year, I think that brings in some concern in the livestock market as well. From a fund manager perspective, if you're thinking that a recession is potentially on the way or is already here, does that warrant maintaining long positions in cattle? Do we see beef demand affected by that? Do we see beef demand affected by the energy values that we're looking at right now? Do we see beef demand affected by overall food prices? Just the cost of going to the grocery store for the average American has gone up significantly. So does that weigh on things? So I think you've got a couple different dynamics that have been at play here, Jesse.
Very true. And I think as well, the hog market, very interesting today. We kind of started a little bit higher and then a reversal out there with pressure. I mean, this hog market, what is your take on what you're seeing here the last couple of days, Brian?
Well, hogs were really strong as of late. We had Mexico taking a lot of pork.
Hmm.
And then we had the key reversal last week. And so the June contract, and this is about as textbook as it gets, we opened in the morning at a new contract high, and that was the high of the day. And then by the end of the day, we had closed below the previous day's low. So anytime you open in the new contract highs and close below the previous session's low, that is your textbook definition of a key reversal. Then after that, we had gapped lower over, I think it was the 20-day moving average, providing some additional weakness. So it looks as of right now, and until this market can do something good to prove itself otherwise, it looks like the hog market has made a major high for the time being.
And looking over as well here, let's talk energies a bit. Crude oil has weakened some. We're around that $100 a barrel mark. What's your thoughts with how crude is looking right now? Because obviously that is a big hot topic in the market.
It is. So we've made some really large sweeping moves recently over the last month or so after the invasion. Reached some levels on a front month basis up to $130.50. Then we saw values go below 100. Then we saw them recover again. Then we saw it pull back again. And so we're really kind of doing this coil. We're still holding what would be the uptrend from that sub $100 trade to the next dip that we had after that. So that uptrend is still intact. However, we're also kind of holding the downtrend from the highs. So we're in this consolidative pattern right now. Some of the news recently was, discussing releasing numerous, 185 million barrels of oil from the strategic petroleum reserves. I think that's a great opportunity for the country if it's managed this way to release oil from the reserves at a high spot value and replace them, 4, 5, 6 months down the road at a discounted price. I hope that's the intention of the administration. If it's not, and they're simply reducing our own domestic emergency supplies, I think that is going to be something that is going to be still create an even more bullish scenario down the road. So I don't know how that pans out, but for now, I'm going to assume that our administration is competent and that's what their plan is.
Well, Brian, before we run out of time, the floor is yours. Any other final thoughts you have for us, or anything else you want to mention today?
Yeah, we're just getting to that point where we're at some very, very good prices for corn. It's getting really difficult to pull the trigger. I know a lot of producers have sales that they have made at what felt like was really good values. Even 5 days ago, D's corn was down in the low 630s after we had that limit down move after, talk that Russia was going to pull troops out of Kiev. And here we are. We've just rallied 80 cents in just a matter of a few sessions here. So I think what most producers that I discuss this marketing plan with, we seem to just rely on the idea that, hey, if we're going to make a sale, let's back it up with buying a call. Let's take the value of that call off the top of that sale mentally right away. But we want to have a blow-off valve over this thing, because with as tight as things are potentially right now, if we have a weather problem this summer and we see some yield drag, and we looked at our meeting yesterday at agmarket.net, the comparison of the drought monitor from 2012 to the last week of March currently, we're in a worse scenario now than we were in 2012. That doesn't mean we're going to have a drought this year, but the stage is set. So I think anytime you're saying, hey, I'm going to make a sale, it's profitable, back it up with a call just to make sure. And maybe even stay away from call spreads. Keep it where it's a complete blow-off valve. So you just buy the call straight up, because we really don't know how high things can go if we do have a problem.
Well, Brian, great stuff as always. And we appreciate the analysis and the commentary and your thoughts. And if folks need a little help with their marketing plan, I know you and the team there at agmarket.net have a lot of great resources for them. And all they have to do is reach out, can't they?
That's it, Jesse. 815-665-0463 is my direct line. 844 for Ag Market will take you to anybody on the Ag Market.net team. So 844-424-6758. Check us out online, www.agmarket.net, and check out the app, agmarket.app.
Well, Brian, we appreciate the time on this Tuesday. Thanks for joining us, sir. Have a great week, and we'll talk to you again soon.
Back at you, Jesse. Thank you.
Brian Splitt with agmarket.net, our guest today here on Market Talk. That's going to do it for our show today. Find more online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.